on to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, it's Phil Tarrant here. I'm the host of the Smart Property Investment Show. Thanks for joining us. It always feels as though I do the same introduction every time. Maybe I've got to mix it up next year, Adam. What do you reckon? Yeah, Adam's our producer here. And anyway, new thing for 2018. But always like to be thinking about the next year. So I'm sure you are as a property investor as well. So I hope you have a good break over Christmas and New Year's. Interesting chat today. So I've done a few back-to-back podcasts recently for Smart Property Investment Show. Obviously, as a company, we shut down over the Christmas period for a week or so. So I've got to get quite a few in the bag. And I'm often quite conscious about whether or not it gets a bit repetitive. So if it has been, I'm sorry. I don't think it is. No, it's not. It's pretty good. All right. Adam says it's all right. We might get Adam on here one day. What do you reckon? You talk about your property portfolio? Yeah? Yeah, should do it. So planning 2018, I've obviously been spending quite a lot of time with my team recently looking at 2018 and what we're going to do. We had a pretty reasonable 2017 in terms of securing properties. If you've been tuning into the Smart Property Investment Show, when we do our own portfolio update, you would have heard this year that we've secured a property in Kingston. Go and listen to that particular podcast. But we also have done a series of podcasts around one of our most recent purchases, and that was a block of 5 units up in Lawton, which is near Petrie or quite close to the new Sunshine Coast University precinct. So that should be a good one. That was a good buy for us, and we just sit on that property for a while, and there's some upside potential for it. But lots of moving parts of our portfolio, and as we go down this path and we secure other assets, this whole wealth creation journey is something which at a point in time, hopefully we can crystallise and realise with a nice comfortable retirement. That's the reason why most people invest in property. But I think a lot of people get confused with that as well once they sort of get going in all the different types of assets that they have in terms of creating wealth and how they can go about making sure that they're making the right decisions. And a lot of people use a financial planner to help out with that. So I thought I'd get a financial planner on the show today who's also a property investor. So hopefully he can speak with a voice of reason and sensibility. Often give financial planners a bit of a hard time because most of them don't touch property, and we'll have a chat about that. But I guess on the show also, I really want to chat about his property portfolio and his journey to getting there, but also while I've got him in the studio, we'll talk about sort of this more holistic wealth creation and diversification of assets and protection, all this sort of stuff. So Max Pagnin, how do I go? Max Pagnin?
Yeah,
right.
Pagnin is how it's pronounced in Italian, but Pagnin for everyone else is fine.
Is that the Aussie way? Pagnin.
That's the Aussie way, yeah.
Oh, Max Pagnin.
I won't tell you my real name in Italian because no one can pronounce it. So
Come on, what is it?
Max, you really want to know?
Yeah, go on.
Okay, it's Massimiliano. But Maximilian, Max for short.
Okay.
So no one can pronounce it, so that's why I got school teachers in primary
Max.
school. Max will do.
So Max, you're a financial planner and also a property investor.
I am indeed.
So we're going to cover sort of both those things today.
Yep, no worries.
Okay with that?
Yep.
So what sort of generation, Australian, Italian generation are you? Sort of first generation, second generation?
I actually am an import. I was born.
Okay.
I was born there in 1971. I'm giving away my age now.
Yeah. So you're true blue Italian.
True blue, true blue Aussie now. But no, I came out when I was 2.5 with my parents via a big boat when it was legal in those days. So we did it the right way, and they can't get rid of me now. So
where in Italy is your family?
Part of the Italy not far from Venice. I was born about half an hour from Venice.
Okay.
In the major city that I live near is a place called Padova,
okay.
which is they've got a really good university. Great little city if you ever get a chance to get there one day.
Yeah. I've been to Venice before. I drove down from Austria once, down through I don't know, the mountains there. I can't remember what they're called. Anyway, long time ago.
Yeah, beautiful part of the world.
It is. It's cool. I guess off topic, but what brought your family out here? What was the rationale for sort of jumping on the boat and heading over?
Yeah, look, obviously, like a lot of migrants back in the day, just for a better life, opportunities. That obviously Australia back in the 70s, there was lots of talk about sort of the land down under and what was available for migrants in terms of work opportunities. So they thought they'd try a new experience in life, and they've been here ever since.
It worked out then?
Yeah, it worked out. Yeah, we did go. Well, the parents tried to go back when I was 14 to try and live there, but yeah, once you've been here for so many years, it's hard to go back.
Yeah.
And a lot of the old Italians have a view of how it used to be, and then when they go back, it's totally changed. Yeah, and I just love it here. So yeah, I would a great place for a holiday, and fantastic culture and history. But I definitely call Australia home and wouldn't want to be anywhere else.
And do you sort of identify being an Aussie, but you just got a bit of a Italian.
Oh well, okay. Well, this will give you the crux of where I identify myself. There, we had, as you're probably aware, a few years ago there was the World Cup where Italy was playing Australia in that second round, and up until that World Cup, I was always following Italy because Australia never made it. So I was getting up early hours in the morning with my dad and watching the games. Now that particular World Cup, we were playing against Italy, and it was my brother and myself and my dad watching the game. Now he was obviously barracking for Italy, and my brother and I barracking for Australia. So I do identify more with Australia if I had to choose. But
you still get all the benefits of being Italian. There's good coffee, good food,
good exactly,
wine.
Pasta. That's right. Yeah, all of that. Happy days.
That's all right. What's I guess a broad super statement, but what's sort of the Italian? How would you sort of compare the Italian attitude to money and wealth creation versus the Australian attitude to money and wealth creation? Is it different?
Yeah, look, I mean, I've obviously known a lot of Italian families over the years, and a lot of them.
I know you guys like cash, but
cash is king. Cash is good. I know we both work with Mundrell closely, and he doesn't like cash too much, but but definitely, cash is king. But also, there's a big focus on property. That's always been that way. I mean, you have a look at the big Italian families out in the West where I live, and there's a lot
concrete
of them,
everything. That's what you need
concrete
to do.
everything. Build what you can. But a lot of them they bought these old little farm.
The market gardens
the market gardens, and now they're worth.
You guys have killed it.
They're worth millions. Yeah. Unfortunately, my parents didn't buy anything like that, but. But obviously, property has been a big focus of wealth creation for the old Italian families, and I think that'll continue to be passed on to the next generation. My mum's been a mad property investor as well, and
really?
So I've sort of taken that on board and run with it as well. So
I've had a lot of sort of Italian mates over the years, and I like they're really happy people to be around Italians. It's always good.
We like to be positive. There's too many negative things out there, and I've always see the glass half full. You've got to try and battle on and as much as possible when things don't go your way. And there's always tomorrow, and there's always a better day ahead.
That's cool. Good attitude. So should it be the same with creating wealth through property? Is always another day is always going to be better in the head?
Exactly. Yeah. When your tenant causes a bit of damage or you lose a tenant, don't worry, that can be all sorted out. But fortunately, I haven't had too many horror stories like that.
Well, let's have a chat about it then. So you're a property investor. When did you get going? Like, what's the backstory of you into property?
Going back a few years now, probably early 2000s, and I probably don't want to admit this too freely, but I did a course with a gentleman called Henry Kay.
Oh, really?
Which, we all know. For those who don't know him or a bit younger in generation, you can Google him, and there's a few negative comments about him, but he did some...
Not the most popular man.
No, not the most popular man. He did a few courses at the time which I partook in, and I guess it was in hindsight it was a good launch into sort of learning about property and getting my feet dipping in the water and having a go, and bought a property at the time in Callum Vale in Queensland. It's one of the suburbs in Brisbane with my now ex-wife, and then subsequently we bought a little property in Tassie in her name at the time. And then we sold the Callum Vale property to buy our first home, which was in Wattle Grove, and that was in 2004. The marriage didn't work out after about 10 years, but as a breakdown of all that, I took over the Wattle Grove property in Sydney, and she held the one in Tassie. The one in Wattle Grove had a greater debt on it, so I was able to manage that debt. She kept the other one, which was positive cash flow. I subsequently sold that a few years later to cash out, but which possibly I cashed out a bit too early in the Sydney market. But the point of that one is that it did take a good 10 years before it actually made money. So there was everyone thinks, and this is a story for everyone that's listening now, property is not a short-term game. It's a long-term investment. As with anything, whether we're talking about shares for that matter, you can't expect to make money within 1 or 2 years. I mean, it's possible. You can get lucky if you buy at the right time, but realistically, you have to hold it for the long term.
So there shouldn't be an expectation that you're going to get rich overnight investing.
Exactly right, and that was a key. That actual house, I bought that in 2004.
So whereabouts is Wattle Grove? Sorry, just for our listeners.
Wattle Grove is out not far from Hammondville, the Holsworthy Army base.
Yeah. So it's in sort of Liverpool sort of way.
Exactly right. Yeah. It's just off the M5 there. It's in a good spot. It's a good location. So it's had some really good growth the last few years. But for about just 6, 7, 8 years of from when we first bought it, it actually didn't do anything. In fact, the first couple of years it was worth less, probably about 30, 40 grand less than what we paid for it. It wasn't right at the peak when we bought. It was actually just a bit after. So probably similarities to the market today. We bought as the market was coming down, but there was still a bit left in the downturn. So look, I don't know what the future holds in terms of the Sydney market, but if I go back and look at my own experience from back then, there was still a bit more of a dip to go, and we possibly could have held out and bought something at better value had we known what was around the corner. But like we said, no one's got a crystal ball. No. But the point is, 10-year time frame, we made some money in the end, but otherwise it would have been a struggle to make money if I'd had to sell it after 3 or 4 years.
Yeah. Okay, so you sold the Wattle Grove property and got some cash? Got some cash,
yeah. Yep. Before I did that, I bought my first property. I saved up a little bit of money and bought one in Minto. Basically, that one was end of 2012. I put the deposit down and didn't settle till January of 2013. So that was just when the Sydney market, there was some green shoots in the market where people were starting to sort of get a little bit excited about it, but still quite early stages. But my reasoning behind that, and I guess I always put my financial planning hat on. The property was I bought for $327, and renting at the time for $380. So
that would have been like a 3-bedroom house,
3-bedroom house, yeah, on a good sized block, 560 odd square meters.
So Minto. Sorry, you can see it from the western suburbs. Minto is it's near Ingleburn, Campbelltown Way, so sort of southwest Sydney. Campbelltown, for our listeners, is quite a sort of satellite hub, sort of for
exactly. And back in the day, it wasn't when I bought it. It was only a few years ago. It had a bit of a reputation behind it. So
we had the rights out there, didn't you?
That's right. There were a few rights there a few years before that. So it didn't have the best of reputations, and a lot of people possibly would not have bought there. But my logic said to me, if I can buy it for $327 at the time and rent for $380, to me, even if there was no growth, and like I said, no one had a crystal ball to know what the Sydney market was going to do, but even if there was no growth, the cash flow looked after itself. Yeah. I didn't have to pay out of my pocket, and that to me was important at the time.
You still have the property?
I still do.
And what's it like now? I reckon you've probably done pretty well out of it.
Yeah, look, that's, if I have to, I had a bit of a look the other day, probably about 620 would be a minimum, might be a bit more, but that's been conservative. Yeah.
So you nearly doubled your money in
4 years or so, yeah, so pretty happy days with that one.
And this is a message for our listeners: don't always expect this to be happening.
Exactly right.
That's the luck bit. It's good planning, good buying, good research, good all the other stuff, but there's a sprinkling of luck in there as well, right?
Absolutely.
Yeah.
But like I was saying, I didn't know what was going to be happening with the Sydney market. Going there because before then it hadn't done anything for. We all know it hadn't done anything for so many years, but my logic said, well, worst case scenario, even if it doesn't do anything for another 5 years, I'm not having to. It's not impacting my lifestyle. It's not going to, cost me a lot of money to hold that property because the cash flow was so good.
Yeah.
But if you have a look in terms of the rental return, I was getting $380 a week rent, and I'm now getting only $400 a week. So it's only gone up $20 in terms of the rent, but the growth's been quite substantial. Would I buy that property now as an investment? No.
Probably not.
No, because for $620, I've got as a minimum.
The yield ain't great.
No, exactly right. So it's all about the right time when you buy these things, and for me, I always try and look at cash flow as well. Not purely cash flow. You want growth, but you have.
You need cash flow. You need cash flow because that's the scenario. You need to hold on to this thing. But what you're seeing there is a story of markets as well. So when you bought it, it was $380 a week, and now it's $400. So it's gone up.
$20 in rent.
$20 in 4 years, right?
It's nothing. Yeah.
And I would say probably one of the reasons why, there's a lot of reasons why, but one of the reasons why would be, I think, a lot of investors probably got into that market. Therefore, there's a lot of rental properties out there, which therefore puts downward pressure on rents because supply and demand. Simple supply and demand. Right. If there's more properties out there for people to rent, that means that there's not upwards pressure on prices to secure them. So
absolutely,
that's the story.
Exactly right.
But it's a growth play. So you've got the capital growth, which is what you want as a property investor, but the yield's still okay because you bought it at the right time.
100%.
Yeah.
And that's it. And I did subsequently take some money out to invest in another property. So that capital growth did allow me to do that, which was fantastic.
Okay, so you've drawn equity out and done some more. So after your Minto property, where'd you go?
Yeah, so I bought a little cheapie in Oberon, and people are thinking, why would you buy in Oberon?
Most people don't know where Oberon is.
Yeah, so for those who don't know where Oberon is, it's as you're going towards Jenolan Caves. For those who know, around Sydney, most people have been to Jenolan Caves at least once in their life. And there's
orange.
Yeah,
orange,
it's going towards you're going towards Lithgow, so you pass the Blue Mountains on Mount Victoria, and you're heading down the big hill, and there's as you're heading towards Lithgow, there's a turn off to the left, Jenolan Caves and Oberon.
Yep, just there.
Yeah, and then so it's probably from here, probably from Sydney, so probably a good, I'd say 2.5 hours probably to get there, but maybe 3, depending how fast you drive. It's a good, nice little country town. It's nothing flash, but I bought a little cheapie for $185, and it was renting at the time for $260. So I bought that for cash flow, not expecting much in terms of growth. To be honest, I thought if it grew, by 10 or 20 grand over 5 or 6 years, I'll be happy with that. But
so you just parked your money for a yield play.
Exactly right.
Okay.
Exactly right. But once again, call it luck or otherwise. I mean, that's probably worth today about $250. That's what the local agents said it'd be worth.
How did you even find it? Did you just go to realestate.com or something and just search by cheapest properties? Yeah,
pretty much. Yeah, okay. Because I didn't have a lot of money left over after I bought Minto. I had a little bit of savings, and I thought, well, what do I do with that? And I wasn't able to buy back into the Sydney market because it already started to sort of move up a little bit, and I didn't have enough to get back into another property in Sydney. And I just thought, I looked going further west, and I thought, Oberon, I'd been out that way, and sort of I knew the town, and I just thought, wonder what a property costs out there.
Is it a house?
It's a house, yeah. It's a house, yeah. It's a 3-bedroom house, yeah.
What sort of land size?
Oh, that one's, I think, about 1,200 square metres.
Okay, so big block. Block. Quite close to the town?
Yeah, you could walk to the main part of town. Like it's literally like probably a 3-4 minute walk, and
just like a fibro house or a brick house?
It's a cladded home. Cladded home, yeah, a little cheapy. No, it's nothing flash inside, but it's comfortable. The previous owner had put a nice new garage and a little. I think he used to play music. He had a little soundproof studio at the back of it. So yeah,
there you go.
And it's got a lane behind it. So I've actually inquired recently. I could potentially put a second dwelling on there and strata title the property. So, cool. But yeah, so it's something to do for the future. Yeah,
potentially good.
Yeah, so that's like I said, it's done all right. It's bought it for $185, currently worth about $250. So renting for now. $270. So rent's only gone up $10 since then. So once again, rents haven't really kept up with the price growth there.
Same thing. Okay, so after Oberon, where'd you go?
So yeah, then I bought. Like I said, that's when I sold the previous home in Wattle Grove that I had, and I bought a couple of properties in Queensland because obviously that was the talk of that's the place to be, and I bought one in the northern suburbs of Queensland, a place called Burpengary. Okay. Just did a bit of my own research there and bought something for a 3-bedroom house for just under nearly $294,000.
Okay.
And that's currently renting at the moment for $340 a week. And I'll be honest, the rent hasn't gone up there since at all. There's been a lot of people buying rental properties there, so the rent hasn't gone up at all.
Same dynamic as what we talk about our Minto, yeah.
Exactly. So, but it's sort of at that price point, it was paying for itself. So, which is the main thing. Like I said, once again, it wasn't impacting my cash flow in any way, which was good. And that's done quite well. I would say that's conservatively now worth about $345 if I had to value it today. So
cool.
So yeah, so there's been price growth there as well. And at the same time, I had some money left over. This is probably the one I'm the most pleased about. Is it was just before Christmas. Would be in 2014. I did a Google search, a realestate.com search on the broader Brisbane area, and I put in my search criteria properties over 5,000 square metres in land. And this property popped up in a suburb called Ellen Grove. And I don't know if you know the area, but it's next to Forest Lake. Most people have heard of Forest Lake in the Brisbane market. And if you have a look at it from an aerial point of view, all the properties there are 2.6 acre lots. And the property that I bought was an older style property. This is a very basic fibro home, nothing flash at all. But the agent had 2 contracts on it fall through, was leading just before Christmas. It was a deceased estate as well, so there was a bit of
So argy-bargy.
But the family members were keen to get rid of it, and I offered a lowball price under land value. Actually, the land value at the time was $620. We negotiated. I picked it up at the end for $583. So it was a pretty good buy at the time. And it's in an area it was owned what they call emerging communities. So it's actually earmarked for future development. And in fact, if you have a look at that suburb, there are some of the streets just adjoining the Forest Lake development. There are actually already have developed some land and house and land packages.
So this is a land banking play then?
Land banking play, correct, yeah. But very poor cash flow.
Yeah.
Very poor cash flow. So $583 I paid for it, and I'm getting $350 a week rent. Plus land tax and all that. That one there, I'll be honest, cost me to hold. I think when I did the numbers, it was about $15,000 a year.
$15,000 a year to hold it.
Just to hold it. Yeah, so it's not the best cash flow for that one.
However, at a point in time, do you think some developer will knock on your door and say,
yeah, absolutely.
What do you think you'd be able to get for the land at a point in time when that sprawl sort of hits it, and then that's the next sort of house and land package area?
Yeah, well, look, I mean, I could...
Was it 5,000 square metres?
2.6 acres, so it's about 10,500 square metres, I think.
Big.
So it's not bad. So it does have a little creek running through it, which will limit what I can do, but it's only a small creak. So
they turn it into little lakes these days. And it helps with the beautification of a place.
Exactly.
So it's a bonus.
That's right. Yeah. So that's it. So I'm looking at it as a long term, but they're in probably, I'd say in 3 to 4 years, I reckon there would have been a lot of developments already starting to happen, and I reckon I can get some good coin for it.
So that's your retirement plan there, is it?
Pretty much, yeah.
So you're paying $15,000 a year now to hold it.
It's actually a bit gone up with the land tax. It's probably closer to $17,000. So that's nearly $18,000 a year to hold that one.
So why are you paying land tax on it? Because you're above the threshold, obviously.
Yeah, because of the size of the land. Because the land itself is now worth $720.
Okay.
And obviously with a house, probably I had an agent tell me last year I could get $750, probably possibly, or let's say $750, probably in today's market. But I don't know what it might be worth in 3 or 4 years' time if everything else is being developed around it. But I think
it's just a waiting game, isn't it? But you need to be able to understand that the holding cost of a property is not just the mortgage; it's the land tax. Land tax is probably the biggest part of that.
Absolutely, exactly right. Land tax is quite considerable there, and obviously just the fact that the rent's so low, and all the other costs. So, but that really then put a bit of constraint in terms of what I could do, because obviously that impacted the cash flow on the other properties. So I then had to look at, what could I do, or where could I buy to try and find something that had a really good cash flow. And that led me to my next property purchase, which people are going to think, well, why would he buy there? But I actually bought a property in a place called Weeper in far north Queensland, which is actually a mining town. Normally I would recommend clients do not buy in mining towns, and there's a valid reasons for that. The reason I bought in Weeper, the company that's got the head lease there and is running bauxite mine is Rio Tinto. And before I bought there, they had announced a $2.3 billion expansion into another mine. So that's definitely going ahead. They're already starting construction there. So for me, that underpins the community there for at least 15 to 20 years, if not more, because they've got to recoup the money, the investment on that mine. So it's not like they're going to close down in 3 or 4 years. So even if I own it for 7, 8 or 10 years and even get my money back, but that one there's bringing in terms of cash flow, I would say at least $10,500 a year. So that's really helped bring back some cash that I needed.
So positive cash flow.
Positive cash flow.
Okay, so you're renting it out for
$580 a week.
Okay.
And I paid $350. It's just a little 3-bedroom. You call it a villa. Yeah.
Okay. So that's a cash flow play to help offset the loss that you're making on these properties.
On the other one with the 2.6 acres. So that's the reason I bought it. I know I'm not buying it for capital growth. I didn't go in with that in mind. If it grows, if it's worth a bit more in 5, 6, 7 years, then so be it. But even if I just get my money back, I'm happy with that, because it's given me that $10,500 a year.
That's really like investing in shares for the purpose of a dividend
Exactly.
that you're receiving.
Exactly.
Same logic, right?
Exactly.
The shares might not go up in value, but you're still receiving a good dividend off it.
Exactly right. Yeah, there are certain shares. I mean, Telstra's one that comes to mind where, there's been a few ups and downs in terms of the share price, but generally speaking, you have, not a good investment from capital growth, but traditionally has paid a great dividend. And a lot of investors have obviously, taken that dividend and done other things with it. But yeah, so similar for that there was a purpose, there was a bit of a method in the madness, and that's the reason why I bought it.
Do you think it'll go backwards though? So a lot of people have invested in mining towns, and one of the classics is Port Hedland over in WA, and properties that were worth $200,000 in 3 years' time or 4 years' time were worth like just south of $1 million, right?
Yeah.
Huge, just because of the level of mining investment going in during that sort of construction phase of the mines. And now they're back down to where they should have been, right? And
Correct.
a lot of people have got absolutely hammered, lost their livelihoods as a result of it. Is that thing, did you buy that before any sort of increase or spike because of this mining investment?
No, there was no spike as such. So as a result of that announcement, so to me, it's just like there is some local demand for people that
so
work
that is
there.
The price of the property, irrespective of any sort of a mining activity that's going on.
Correct. Yeah, I didn't buy it. I didn't pay overs for it. I didn't pay sort of more than it needed to be. In fact, I got a bit of we negotiated a slight discount on the asking price.
Okay.
But
cool.
As I said, it was purely just for the income, but it may go up in value. I'm not sure. Who knows? If there's enough people sort of, because obviously with a new mine being built, there's going to be demand for more services and nurses, doctors, and things. Yeah, but as I said, if it doesn't, my fallback position is that it's going to at least hopefully give me my money back in whenever I sell it. But in the meantime, it's given me that really good cash flow to help offset the negative cash flow from the Ellen Grove property.
So for our listeners, what we're talking about here is this is I guess the insights into a sort of more sophisticated investor where every property has a purpose is what we're talking about here. And a lot of people just buy property for the sake of buying property that hopefully goes up in value and gives rent. But you're actually pairing properties. You're strategically acquiring assets to serve a purpose.
Absolutely, yeah, and I guess maybe that's my financial planner coming out of me. So when you're looking at a traditional portfolio for a client in their superannuation or just a pure managed fund investment, you have to look at different types of funds and how they blend well together. You might have a fund that sort of focuses on the big stocks, and then you might have another fund that sort of focuses on the smaller stocks that has a different profile. But yeah, you blend things together, and that's sort of the way that I've done my property investing up to now.
Great. Okay, so what sort of properties from there? At
that point in time, I also bought one in Tasmania. It was my first sort of venture in Tasmania, which was a place called Midway Point. I bought that for $262.5. That'd be worth probably $305,000 now. And I'm getting $335 a week rent. That actually came with tenants in place. Now, there's obviously a lot of people know that the Tasmanian market, especially Hobart, has done quite well in the last 12 to 18 months. So I had been to Tassie and Hobart in particular a number of times over the years. I liked the place. I could see what was happening on the ground there. For those who have been there, if you go to Mona, which is it's a museum and I don't know what it stands for, but it's basically like an art museum, but they have some really funky exhibitions there and sometimes controversial, but it's a really good place. It's always busy, and that has brought a lot of interest in terms of tourism to Hobart. But not only that, the economy is actually doing quite well. So I did a bit of research and saw what was happening on the ground in terms of the economy, in terms of jobs growth, and
so these are looking for the fundamentals which drive the increase in property prices.
Exactly right. So I mean, I'm not expecting the same growth as what I've had in Sydney. But once again, if I look at purely from the numbers perspective, I bought it for $262.5 and getting $335 a week rent with tenants already in place. To me, it was a no-brainer.
So good yield,
yeah,
good potential for capital growth.
Exactly right, based on the fundamentals there. So that was the first sort of property down there, and then I I liked what I saw, what was happening down there, and I've subsequently bought another 3 properties
in Tassie,
in
Hobart.
Yeah.
Okay.
So
heavy in Hobart.
Heavy in Hobart,
yeah.
but yeah, it's been a good call. Whilst other sort of experts have been talking about the Brisbane market and hasn't done much, in the same time period. I mean, all of my properties there have grown, by over 10% since I've bought them, and one actually. My second one that I bought down there was a cracker of a deal. I bought a 2-bedroom house that had a granny flat at the back, which I could sort of lease out separately. And that one there, we negotiated on $280,000, but as part of the building inspection, there was a bit of a crack in the granny flat, which was built sort of at a later date. It was a brick. 1-bedroom sort of dwelling, and the inspector said there was some issues with the footings, and I got an expert report to sort of see how much it would cost to fix, and this bloke said $26,500 to fix it. So
they took it off, did they?
Which I think was pretty hefty, and they took it off the price because I was actually going overseas for a holiday, and I said, well, if we don't take it off the price, I'm not going to sign up. So it was a deceased estate once again, so they wanted to shift it. So okay, well let's take it off the price. So now that property there.
Did you fix it, or did you just leave it?
No, because I since got another person to have a look at it when I got back from the holiday.
Yeah, $2,000. Don't worry about it, cash.
Well, no, he said $6,500.
Yeah.
But he even told me, he said it doesn't need doing straight away. Like it's nothing pressing, it's not urgent. So I've got tenants in there and they've never complained about anything shifting. So it's not an urgent repair, but something that I'll probably attend to at some point.
Yeah.
But that that property there, if I look at what's happened in the market, that'll be worth I would say a good $325,000. So it's done quite well.
Good.
Yeah, so in a short period of time, and I was getting $410 a week rent for the two combined. So once again, healthy cash flow, good yield, and I've since increased the rent on both of them. So by $10 each, so I'm getting an extra $20 on what I was getting last year. And that's the good thing I like about the Hobart market is it's got very strong rental yields, low vacancy rates. From when I last read about it, there was perhaps the lowest in the country, I believe. So so from that point of view, you've got some good fundamentals in place. Yeah, you've got strong yields, you've got demand for properties there, obviously, for those rental properties, and obviously that there's also a demand for buyers wanting to buy a property to move into, and that's where the growth is coming from. So even if it doesn't, if it grows for another couple of years and then it stays stagnant for a while, at least I've made some money because I bought in at the right time.
Interesting
at the right
portfolio.
price.
So we spoke about beforehand, every property's got a purpose. It's a reason why you've acquired these things, and obviously there's the immediacy of why you're securing them, but also there's a long-term play as well. So you're looking to get both.
Yeah. And exactly right, and the ones I've bought in Tassie, especially the last 3, I can add value to them. They're cladded homes. Actually, they're pretty funky colours. I've got one that's pink. Okay. I've got a green one, another green with a different tinge of green. But
Max and his technically-coloured property portfolio.
Exactly. But I can quite, I will be doing that at some stage, getting them repainted to a more modern colour, and that adds value, street appeal, and all of that. Great. So. And and the last one I bought down there was in May. I got a bit lucky with that one. It had been fully renovated, and I exchanged just before, like 10 days before the budget announcement, where they got rid of the depreciation. So I jagged a good deal on that one. And look, in terms of, as I said, I've got if you've done a count, I've got about 9 properties right at this minute, and they cost me in total, this is pre-tax, $2,300 a year to hold collectively.
So that's based on one costing you $15,000 to hold. Closer
to 17,000, 18,000. And all the others giving mostly positive cash flow. So $45 a week.
That's net.
That's before tax.
Before tax, okay.
Yeah, so when I take depreciation into account, because I've got depreciation schedules done, which I recommend every property investor gets done.
Down speed to BMT, they'll sort you out, or Washington Brown.
I use Geotax. Twan, he looks after me. I get some good money back on that. So basically, if you take the depreciation into account in the current financial year, I'll be about $15,000 positive cash flow.
Okay.
So
That's good.
Yeah, I'm not complaining.
Yeah, well, spoken like a financial planner.
Exactly.
You know?
So yeah. So and as I said, I there are clients here that focus on the high growth properties, but you at some stage you have to be able to hold those properties.
Yeah. Well, it's a balanced portfolio now. So have you stopped doing what you're doing and just left it, and it was delivering you positive, after
tax,
the impact or effects of tax at plus $15,000? If you don't do anything now and just left that portfolio in 10 years, 20 years time, it would be a very, very different proposition.
Exactly right. So yeah,
and that's the beauty of long-term investment, wealth creation through property.
Exactly right. So yeah, so I'm I guess you could call me the property investor's financial planner, because I understand what property investors
so what's
like
it all
to do.
about? Why? And we work with a lot of wealth advisors within our business. We've got big products for, Insto, retail funds management, financial planning, all this sort of stuff, right? But often financial planners don't touch property, and just the reality of the market. But how do you find yourself a good financial planner who actually is property savvy? Because most of the time they'll stick you into some shares or managed funds or some trees up in Queensland, or you know what I mean?
Yeah.
Why is it that financial planners typically don't chase property?
Yeah, look, I think it's more of an industry thing where it's not a financial product as such, so it's hard to advise on property. So and traditionally financial planners have made commissions on investment products, and especially those trees that you're talking about, and those ostriches and emus and all that sort of fancy stuff. There was some big commissions paid to at the time.
I know a guy with trees, and I just sit there going,
"Oh yeah, shake your head, don't you?" So so traditionally a lot of planners have because if it's a financial product, they can make a fee out of it. They will basically promote that product, and obviously just in terms of the training we get, we're trained to sort of focus on liquid assets like shares and bonds and etc. that are easy to sort of liquidate, and property's obviously not that kind of investment. It's not, you can't sell a bathroom or a bedroom if you need cash out of your portfolio, whereas it's easy to sell a parcel of shares. Exactly. And at the end of the day, look, it is about diversification. Whether properties, you should have some other assets that are more liquid as well, not just purely property. So I think it is a bit of a balancing act there.
So your recommendation is balance. So
absolutely, yeah. So but at the end of the day, if you're looking for a financial planner that you trust, and ask the question, do you invest in property? Are you a property investor? And then you'll soon find out if all they're talking about is shares, and that's the only thing that's they're wanting to talk or put on the table, then maybe that's not the planner for you.
And is it okay to ask a planner or a wealth advisor how you get paid? Is that cool?
Of course it is. I would always ask how you get paid. It's a bit like engaging a buyer's agent. You want to know how they get paid, whether they get paid as a fee that they charge you, or whether they get paid from a commission from the developer. If it's a new property, so you should always ask that.
Yeah, and a good financial advisor will be sort of a fee for service type operator. Do you believe?
Yeah, generally these days that's the way that the industry is going. Some might still be charging a commission, but generally it's mostly fee for service.
And that is, I'm paying you for your advice, for you to look at my personal wealth situation without any prejudice or product preference anywhere else. That's
correct.
Like, this is you. And here is a solution that meets your needs.
Absolutely, yeah. That's
based on your appetite for risk, no doubt, based on your assets that you currently have, based on your capacity to earn, based on your age, based on all that sort of stuff.
Exactly, and everyone's different, because I always get asked one of the questions, how much do I need to live on when I retire? And that's how long's a piece of string? Exactly, because I know clients that quite comfortably will live on $35,000-$40,000 a year, but then on our other clients that if they didn't have $100,000 coming in every year, they'd be struggling. So it depends on lifestyle and what you, I guess, used to.
And that's what you should be thinking about when you're looking at wealth creation, as in, what do you want your life to be at a point in time when you choose not to work anymore, or you're forced not to work anymore, and work backwards from there.
Yeah, that's right. You've got to always look at the end game. What are you doing it for? A lot of the people listening to this podcast will be saying, well, I'm buying all these properties. Okay, why are you buying them for? What's the end game? What do you want to achieve from that portfolio? What's the plan with that portfolio? What's it going to do for you in the future? Because at the end of the day, as you said, retirement is, for me, is not where you must retire by a certain age, but it's having the choice to make that decision. I don't want to work anymore, or I might only want to work 2 days a week, whatever it might be. I want to take 6 months off a year. It's having those options available to you. But if you don't plan, you're not going to get there. So whether it's shares or your super or property, you must have a plan in place for that long term.
And when would you, or when do you see with clients you would choose shares over property? It's a big question, but because when you look at the growth in the share market over the last 20 years versus the growth in property markets over last year, most of the wealth, most of the increase in share markets is because of one or two or a handful of incidences which pushed it way up before they come way down. It's very volatile share trading, is my view. Unless you really know what you're doing, if you're in and out or you're a day trader, you can make a lot of money, you lose a lot of money as well. And most Australians in some capacity have some exposure to the share market because of their superannuation, whether it's in a retail or industry fund. I have exposure to the share market because I have a retail fund, which I've spoken about before. I get a woeful return on, which I'm going to change it to a sovereign super fund. But anyway, different conversation. But how do you know? Because most Aussies just don't have the sophistication to invest in shares, I believe.
Exactly, and then you're right. And most people have exposure to shares via their super, whether they know it or they don't. But and the good thing about that type of exposure is the fund managers that manage that money generally will invest in good quality stocks and good quality companies. Yeah, well, that's right. So they're not going to invest in some speculative share that's worth 10 cents that might go up to $1, but it might go down to 1 cent. So at the end of the day, it's about the research that they undertake to buy those sorts of shares and companies that long term will do well. And at the end of the day, like shares, like property is a long term game, but you do very well with shares as well. But it does give you that liquidity that property just doesn't give you.
Yeah.
And so, as I said, when I see a client, okay, what have you got in terms of liquid assets that are still going to grow for you? But if you need to in the future, cash out for any reason, you've got that flexibility.
Quickly.
Yeah, you can move quickly. Yeah.
Yeah. Good. Nice one, Max. Enjoy the chat.
Yeah, likewise. Cool. Yeah.
Nice
So
finally met you and get you on. Let's get you back in, and I think we can probably continue. I know you shared primarily your property portfolio today, so thanks for that. And one of the key learnings I would take from Max's portfolio construction is the fact that it's been very deliberate about how he's going about doing that, knowing that some properties are going to deliver great yields and potentially not capital growth. On the other side, some are going to deliver great capital growth and not the yield. And also a couple of long-term plays in there, which is, you might say it's a bit specky in terms of sort of land banking, and it's costing you quite a lot of money to have that play, but if it comes off, you should be sweet.
Yeah, and that's it is that one was a bit speculative, but it's balanced out by the other properties that have got the cash flow. Like if I have a look at my overall portfolio, apart from that one with the land banking opportunity, the rest I'm getting a gross yield above 6% for all of them. So
pretty good.
Yeah, on what I've paid in terms of so it's pretty good.
Nice. We'll get back and also talking a little bit more about this the whole wealth creation thing, and we haven't really touched on it, but the need for protection as well. I know a lot of people don't want to think about insurance and dying and all that sort of stuff, but you need to make sure as part of a good wealth creation strategy that you got that sort of stuff.
Yeah, absolutely. Because a lot of property investors that I come across are quite well geared in terms of the loans that they have out there, and they're exposed. And if something happens from a position of, even if it's not a death, but it could be an illness or a disability that they're off work for 6 to 12 months, then that's going to have a significant impact on their cash flow and the ability to keep repayments up on their home or their property portfolio. So
it can start getting tricky.
Exactly.
Yeah.
So you need the right safety nets to make sure that if something happens, you're protected, you and your family.
Yeah, and also sort of good estate planning as well.
Absolutely.
So what happens at some point in time when
exactly
we all meet our maker. So thanks, Max.
Thanks, Phil.
Remember to check out smartpropertyinvestment.com.au. If you're not receiving our daily morning market intelligence, smartpropertyinvestment.com.au/subscribe. We're on the social stuff. Just search Smart Property HQ. If you want to have a chat with us, editor at smartpropertyinvestment.com.au will answer your questions, and please keep those reviews coming on iTunes if you like what we're doing. Just hit 5 stars, and the team do enjoy the feedback. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.